If you have a mortgage on a residential rental property, there's one tax rule that probably affects you more than any other. Section 24. It quietly changed how landlords are taxed, and if you report it the old way under Making Tax Digital, every quarterly estimate you file will be wrong. Let me show you exactly how it works, who it hurts, and how to report it correctly. Here's the rule. If you hold residential property personally in your own name, not through a company, you can no longer deduct your mortgage interest as an expense against your rental profit. It's been fully enforced since April 2020. Instead, you get a basic rate tax reduction worth 20% of your finance costs. Finance costs isn't just mortgage interest, it includes interest on bridging and development loans, loan arrangement and broker fees, valuation fees tied to borrowing, and alternative finance payments. What's not got? Commercial property interest and anything held through a limited company. These remain fully deductible. So why do landlords get this wrong? Because for decades, interest was just another expense. You put it with your repairs, insurance, and agent fees, and it came off the top. The instinct is hard to break. On top of that, generic bookkeeping software treats mortgage interest as a standard deductible cost, which is correct for a company or a commercial unit, but wrong for residential property held personally. If the software does not separate it, you have to remember to do it manually every quarter for every property. Let's put numbers on it. Raj is a higher rate taxpayer with one buy-to-let. Rent is £30,000 a year, mortgage interest is £20,000, other expenses, insurance, repairs, agent fees are £4,000. Under the old rules, his taxable profit would have been £30,000 minus £20,000 minus £4,000, so £6,000 tax at 40%, about £2,400 of tax. Under Section 24, the interest isn't deducted. His taxable profit is £30,000 minus the £4,000 of other expenses, so £26,000. At 40%, that's £10,000 and £400 of tax, but then he gets a 20% tax credit on the £20,000 of interest, which is £4,000. So his tax is £10,400 minus £4,000, or £6,400. That's roughly £4,000 more than under the old rules, and £4,000 is exactly 20% of his mortgage interest. That gap is a Section 24 cost for a higher rate taxpayer, and it grows with both your tax rate and the size of your mortgage interest bill. Two more things you need to know. First, the credit is capped. It can't exceed the lower of your property profits, your income after the personal allowance, or your remaining tax liability. If your interest is very high relative to your profit, you may not get the full 20% in that year. Second, any unused credit isn't lost. It carries forward to the next tax year. And here's a trap for former holiday let owners. The Furnished Holiday Lettings regime was abolished from April 2025, so former FHLs are now caught by Section 24 too. If your software still treats them as a separate trade with fully deductible interest, that's now wrong. Under Making Tax Digital, that becomes a quarterly issue, not just a year-end one. HMRC's category structure has a specific line: residential property finance costs, and your interest must go there separately every quarter. Even under the simpler categorization easement, the finance cost figure must still be split out. If you misclassify it as a general expense, your in-year tax estimate is wrong all year. For joint owners, the finance cost is split at each person's share, and because each may be on a different tax rate, Section 24 costs them different amounts. 3 mistakes to avoid. 1. Deducting the full mortgage payment, which also wrongly includes the capital repayment, but that's a record-keeping trap for another video. 2. Putting interest in with general expenses instead of finance cost category. 3. Assuming a former holiday let still gets full interest relief. It doesn't, from April 2025. So, what should you do? First, separate your finance costs into their own category from the very first quarter. Don't wait for year-end. Second, get your lender's annual interest statement so you know the exact interest figure. Third, if you have a mixed residential and commercial portfolio, split the interest on a reasonable documented basis. Fourth, track any carried forward credit year to year so it isn't lost. Fifth, if you're a higher rate taxpayer feeling the squeeze, taking proper advice before making any decisions, such as transferring the property to a limited company. Myth: my mortgage interest comes straight off my rental profit. Reality: for residential property held personally, it's relieved as a 20% tax credit, which costs higher rate landlords more than the old deduction did. Section 24 isn't going away, so the priority is reporting it right. RentalBux enforces the finance cost category at the point of entry, record a mortgage interest payment, and is routed to the Section 24 line automatically, split at each co-owner's share. Start your free trial or book a demo to see it on your own numbers.